The heavily anticipated U.S. Federal Reserve meeting is now in the rearview mirror, and the stakes were high as investors had become worried about a communication error in the form of a hawkish pivot. So did Fed Chair Powell successfully walk that high wire? Let's break it down. So Fed Chair Powell did meet the moment, and he met investors' expectations related to the tapering of the Fed's quantitative easing or bond buying program that had been previewed at prior meetings and was fully baked into market expectations. So the Fed's going to reduce its current pace of $120 billion a month of bond buying at a measured pace, ultimately ending the QE program in mid-2022. But that said, the Fed's going to maintain the size of their balance sheet after the completion of the taper. And for context, the Fed's balance sheet has nearly doubled to $8.6 trillion since the pandemic. Interestingly, for those who worry about who's going to buy the treasuries that the Fed's not buying under the taper, the Treasury Department also announced a reduction in coupon issuance of bonds across the yield curve, initially by nearly $85 billion this quarter, but it's possible that the reduction could offset the Fed's tapering. That's good news for investors. And next, the fears about a hawkish pivot were unfounded as Powell continued to message patience as it relates to any change in interest rate policy. He was very even-handed, acknowledging that the inflation that we're all feeling today has been lasting longer than he had hoped. But he's sticking to his view that ultimately it will dissipate over time. It was apparent, though, that he sees the risk to inflation being to the upside. We agree, and we also acknowledge that the risk that inflation sticks around longer has risen, particularly on the wage front. We're going to be watching that data really closely. But for now, we remain team transitory as it relates to inflation, and we're already seeing signs of stabilization, if not improvement, in some of the supply constraints that have really driven these higher prices. Like Fed Chair Powell, we continue to focus on inflation as the number one issue facing households and investors. We observed that market forecasts for near-term inflation have risen significantly over the past several weeks. That's driven short-term interest rates higher and embedded a market expectation that the Fed will ultimately hike interest rates in 2022, perhaps 2 times. Our view is that that's too aggressive, and we don't expect the Fed to change the interest rate policy until late 2022 at the earliest, but most likely not till 2023. Our view is that inflation is going to come off the boil in mid-2022, around the same time we see demand growth normalize. Ultimately, this is going to take pressure off the Fed to raise rates. So the bottom line is that we're sticking with our low-for-long thesis on interest rates, and we're siding with the Fed despite many investors taking the other side of that trade.